Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, last week's show was titled, Is Market Volatility and Fear About to Explode Higher? Now, I feel like somewhat a Nostradamus or maybe the kiss of death, because no sooner had we clicked publish on that particular episode than all hell broke loose on investment markets, but in particular the technology stocks in the US, and that was epitomized by the drop in the NASDAQ. Now, if we jump back to last week's show, I talked about three key things I was looking at. So one was the dollar index. I warned of a potential spike higher. There was some technical analysis that was suggesting potentially a turnaround in the downtrend we've seen for the last couple of months. And of course, the dollar has been driving pretty much everything in markets, despite it not being recognized by most investment headlines. So a weakening dollar has been boosting US equities. It's been good for things like commodities, particularly gold. And of course, all those momentum trades that have been pushing higher in the last couple of months were always prone to unraveling and reversing course if the dollar started to break higher. And I pinpointed the dollar index as one to keep an eye on in recent shows, but particularly last week. So the dollar index did start to break higher in the last week. And actually, the dollar index has pushed up probably around about 2%, which doesn't sound a lot, but it's enough to start to cause a wobble in investment markets. But on top of that, I mentioned the Kospi, which is the South Korean major stock market index, and the correlation with the NASDAQ 100. So go back to last week's show to listen to that. But I highlighted it as a potential bad omen for the NASDAQ, and we could see some weakness if that correlation was to be maintained, because the NASDAQ had diverged away from the Kospi. The NASDAQ had been continuing to push to new all-time highs. Well, that's what we got. And of course, we got a spike in the VIX as well. Another indicator I was talking about last week had pushed above a key moving average, and there was history that suggested that we could get a spike higher. Well, we got that. That VIX, the market fear index, spiked higher. We're back above 31, which is always a key level. When it's above 31, it's normally very bad for equity markets, and we tend to get a bit of a wobble and perhaps a pullback. But it got up as high as 37. So after last week's episode, the NASDAQ almost imploded. In fact, it entered correction territory. Now, if we go and look at the stock price of Tesla, that probably epitomized the carnage that we saw in the last 7 days. And in fact, don't forget that the US market was actually closed one day for Labor Day. So all of this happened in a shortened week. The Tesla stock price has plummeted. In fact, it's entered a bear market theoretically, or technically, I should say, because it's down more than 20%. In fact, yesterday, so that was on Tuesday, the share price of Tesla fell more than 20% in one day. So that brings the fall since the beginning of September to around 33%. Now, I've got to add that the share price of Tesla is still up 238% year to date. So it's still mind-boggling. But we've had this incredible pullback, and it has obviously had a knock-on effect for the rest of the technology stocks in America, which is obviously a very concentrated and overinflated trade. There are a lot of people betting heavily on the NASDAQ pushing higher in technology stocks. So there was a lot of concentration there. Now, part of the reason that the Tesla share price collapsed was because it wasn't included in the key equity index in the US, the S&P 500. Now, a lot of people were expecting it to be included this week when they rejig the indices every now and then, and some firms drop out of the indices and some new ones are added. Now, Tesla is obviously a very big market cap, and that was going to be added to the index and was obviously going to cause a bit of a stir. Some people thought that anyway. Well, this week it didn't make the cut. So that meant a lot of people who priced in a rally or further rally in the stock price, or the fact that the Tesla stock was going to be in the S&P 500, started to pull their money out. And that's why we saw this reversal. Now, there wasn't a major catalyst for this pullback in US equities as such. The dollar index being one of them, the VIX spiking higher, another one. But there wasn't one thing that people could lay their narrative on to say that caused the collapse. But there has been some interesting news that's come out of Japan. In fact, SoftBank is a conglomerate in Japan that basically runs some very big venture capitalist funds. And there's one in particular that invests in a lot of global technology stocks. And in fact, it came to light they'd placed £30 billion bets, so call options, on some of the largest tech companies out there. And they'd been sitting on about a £4 billion profit on paper anyway. And so what this means is that they were being classed as a whale, as the one of the biggest drivers of the rally in technology stocks that we've seen since August. If you look at the NASDAQ, or you look at Tesla's share price, or you look at Apple's share price, you can see that from August, they really took off and they started to be even more detached from reality. And so some people are blaming that it's actually SoftBank that were doing this or behind it. So that obviously leaves the market very exposed. So there are a lot of concerns that this wasn't going to be sustainable and that SoftBank were behind this and it would all implode. So therefore people started to pull their money out of the market. So as I say, we saw a correction in the NASDAQ. We saw big tech names falling by more than double digits. And like I say, Tesla fell more than double digits in a day. It fell more than 20%. Perhaps it was prophetic last week that I likened Tesla to Bitcoin in its heyday. We'll have to see what happens. Of course, we're always likely to see a bit of a rebound in the coming days. When things fall so hard, so fast, then you do tend to see a bit of a rebound. So we'll have to wait to see if that materializes. Of course, what that meant for the S&P 500 is that we've seen the S&P 500 itself now fall more than 5% since the beginning of September. And it was interesting to see how that transferred around the world. Now, we didn't see as much weakness in the stocks in the UK, for example. The Ftse 100 is up around 2% for September. And a lot of that is down to the weakness in the pound, which I'll come on to a bit later. European stocks broadly are flat so far this month. So it's been very concentrated in US technology stocks. So we'll have to see if that carries on. If it does, then it is likely to filter out to around the rest of the world and other equity markets. So the S&P 500, the NASDAQ, they are all now currently bouncing along their 50-day moving averages, which is a line that a lot of traders look at. Of course, the NASDAQ has crashed down through that 20-day moving average that I've mentioned. Now people are looking at the 50-day moving average. I suppose it's a case of choose your lines, if you like. People will choose whatever they can to fit their narrative, but it does mean that uptrend technically is still intact. We have to see what happens in the coming days and weeks to whether this is going to unravel even further. Now, of course, one of the concerns for the S&P 500 is that it has given up the high from February, so it's pulled back below that level. So again, you're going to hear people talk about double tops. And is the market now going to just roll over? We've got to wait and see what happens. It's too early right now to answer that question. Interestingly, the Ftse 100 is still below that 6,000 level, which seems to always be a key threshold. It's a nice round number. It's a level which has been resistance and support in the past. So we would want to see the Ftse 100 break up through that if it's going to continue higher and outperform or continue to outperform the S&P 500. That's what's been interesting about markets at the moment, is that in September we're starting to see a reverse of a lot of what we've seen earlier on in the year. The momentum trades are starting to unravel. Cyclicals are starting to be preferred. We're seeing the UK and Europe outperform the US. These are things we've not seen since the rebounding markets from the March low. Now, if I look at bonds in the last week have had a bid. They've actually started to perform fairly well. We've seen the US Treasury yield fall back below 0.7. It hasn't collapsed as you thought it might do, given that markets are selling off in America. So it's offered some protection, but not as much as you'd hope. And equally, we've seen the 10-year UK gilt yield fall below 0.2%. So again, the gilts are rallying. So again, that's offering some protection to portfolios, but not as much as you would hope on a balanced portfolio. Even gold hasn't rallied as much as you'd think, largely being flat. Now, where the action has really been interesting is in the currency markets. As I mentioned, the dollar index has been pushing higher, but the pound has been falling and it's been tumbling even below the key $1.30 level. Now, as I make this show, it's heading towards $1.29. If it keeps continuing, then keep an eye on the $1.20 27.50 level to see if that holds a support. And now this has been happening because of Brexit. It's back on the table. There are suggestions that we could crash out without a deal. That obviously is a concern. It's always put pressure on the value of the pound, as it's obviously seen as a vote of no confidence. And so don't be surprised if we see some more volatility in the value of the pound. The good news is that if you've invested overseas, then that has been a buffer to any falls that you've seen, particularly in the US, because the currency exchange rate means that your overseas holdings get a boost from the fall in the value of the pound versus the dollar in particular. So those falls you've seen in your perhaps US tech holdings have had a little bit of a buffer. They're not as bad when they're converted into pounds as they could have been if the pound had rallied, for example. So pulling that all together, we are at a point in markets that feels slightly reminiscent of where we were perhaps back in February, where the market started to pull back, in America in particular. Are we going to get a rebound? But what happens from there? Will it then turn over and roll even lower? Don't forget, we've got the US election coming in the next couple of months. Also, next week, we've got the US Federal Reserve having a meeting, so we might get an interesting decision from them. Nothing is expected to be, I know fireworks are expected. We're not expecting any particular new announcements on monetary policy, but they can always surprise the market. I think the market is looking for the Fed to do something. The fiscal policy from the US government, whether they're going to add more stimulus, more checks they're going to shower onto the US citizens, hopefully can start investing in the markets as they have done. But as it stands, we are in a bit of a pause, a calm in the storm that we've had in the last week. And it'll be interesting to see what happens in the coming days and weeks ahead. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Twitter, moneytothemasses with a number 2. You can find us on Instagram, Facebook, and of course, subscribe to our YouTube channel.